to that, we're also going to show some comparisons of the collar spreads to the various types of parity trades. We're taking a look at the first screen here, variety, the spice of the collar spreads. Collar spreads are very dynamic positions. They can be used in a multitude of different market environments. For those experienced options investors that are joining us this afternoon, you look at the four little charts I have down here at the bottom, and the first thing you might say is, okay, well, it looks like there's a credit spread trade or a debit spread trade there in the center, and flanked to the left and the right of it appears to be a calendar spread. But all four of these profit and loss charts that are shown are actually all collar spread profit and loss positions, believe it or not. Each one of them was designed by buying stock, selling a call, and buying a put option against it. So even though they all look very different and they all appear to have much different profit and loss levels and much different market sentiments for each one, you would use each one in a different environment. These are actually all collar spreads where we are long the stock, short a call, and long put. Okay, we've got several other people still coming in here, so we're just going to wait for the room to fill up a little bit. I just want to remind everyone that this first presentation here, the strategy discussion on collar spreads, we're going to actually continue this with a part 2 next Thursday night at 6 p.m. Eastern. Part 2, what we're going to do is delve deeper into some of the management concepts and using the PowerOptions portfolio tools to manage the different types of collar spreads that we're going to be discussing this evening. We're not going to get through every one of the various forms of collar spreads tonight, but we're going to give you a good introduction and hopefully a good feel about how you can use the different collar spreads, of course, focusing on the standard collars first, and then moving into a wider variety of positions, and even what to look for and what to avoid when comparing these into different parity trades that can be used as well with similar profit and loss charts. All right, let's go ahead and get started. Before we jump in, for those of you that do not currently have a trial to PowerOptions or are not subscribers, let's just review what is PowerOptions. PowerOptions is a patented suite of search and analysis tools that was designed by Ernie Zerenner about 12 years ago for self-directed options investors. He had originally created the website to trade his own account because he couldn't find the tools that he wanted to use to help him save time and be able to quickly manage his positions online or anywhere else. So he designed a tool for himself to do that. These patented tools allow you to search the entire universe of options in mere seconds. We support over 23 different option strategies. Once you've identified the positions, you can quickly compare the risk versus reward of one position to another. And then we also have very powerful tools to help you paper trade, track, and manage those positions as well. In addition, of course, we have countless education articles, help pages, and pretty soon we're going to have a virtual library of recorded webinars on different topics and subjects ranging from the option strategies to the simple use of the tools on PowerOptions and, of course, the more advanced use of the tools on PowerOptions as well. PowerOptions has been in business for over 11 years, and with the staff on board, we have many, many more years of combined trading experience. Okay, my name is Michael Chupka. I'm going to be your presenter this evening, and I'm grateful to see all of you here joining us this evening. I'm the Director of Education here at PowerOptions. I've had the great pleasure of working with Ernie and Greg for the past 7 years. I handle most of the coaching sessions, blog articles, and some of the educational materials here at PowerOptions. I've co-authored 2 books with Ernie Zerenner, one which we're going to be delving into tonight, topics from the Protective Options Strategies book, which covers married puts and collar spreads as well. And I'm essentially versed in all strategies on the site. And I should mention that before I go any further, there is a question pod over on the right-hand side that you can use to send in questions during the presentation. I'm going to ask that you try to hold your questions until the end. It's possible that I might answer your question during the presentation, but just in case, I do have someone backing me up here in the office with me this evening. Mr. Ernie Zerenner is going to handle some of the questions as they come in, and he might even chime in once or twice and join our conversation here if he feels that there's something that I overlooked or something that he wants to add to the general discussion. Okay? All right, so let's go ahead and move on. And let's just start off right off the bat. Why collar spreads? Many of you who have traded options before, you may have been introduced to covered calls, you may have been introduced to naked put strategies, which in a sense is a parity trade to covered calls. I'm going to be using that term frequently this evening, the term parity trade, which that essentially means that almost every option, just about every option strategy, I should really say all option strategies, have a parity trade that can be used in a different way to create a synthetic trade that has a similar or almost the same risk-reward profile. I can't say that they are the same because we'll show this a little bit later, when we're comparing a collar spread to some of its parity trades, you'll see why they are vastly, vastly different. Okay? But each one has its own place. However, the collar spreads offer us a wider range of diversification for uncertain markets. We can still achieve reasonable profits similar to the returns that we might see in covered calls or naked puts. By that I mean when I'm doing what we're going to see soon is called a standard collar position. I usually expect to make around 2.5 or 3% on the positions that are profitable, that go in the direction that I want, and I expect to see the same type of returns in covered calls or naked puts. I know there are services out there that claim that you can make 5% or 8% trading covered calls or naked puts. In my 7 years experience, I've never known that or seen that to be possible. Okay? If someone can show me that, hey, that's great. I'll follow along with you, buy what products I need, but I just don't think that's a reasonable return to expect with those kind of positions. What a collar spread offers over a covered call trade is that even if you're trading a covered call where you buy stock, sell a call against it, and then even use a stop loss to limit your loss, if there's a major gap down in the market, either in pre-market or after hours, your stop loss can get violated and you can still have a significant loss. In these types of uncertain markets, I feel that a collar spread is a little bit better way to approach trying to achieve a monthly return of maybe around 2.5 or 3%, because as we're going to see, buying the put option with the covered call trade gives us a guaranteed limited risk. Even though stop losses can be violated, we are guaranteed to have a limited risk. And these positions, based on how you set them up, what you're screening for and what your market sentiment is, are very flexible. You can make adjustments to the call and the put. Even entering the trade, you can play around with how far in, out, or if you want to just be at the money with the call and put to match a risk-reward profile, a profit and loss chart that matches your expectation going forward. Okay? Now, there are a variety of collar spreads, and just in the basic forms, we like to refer to a long collar as a simple form of buying a stock, selling a call against it, which obligates us to deliver shares of stock at a set price, and at the same time buying a put option, which guarantees us a price where we can sell the stock to limit our losses. Now, the variety is abundant by simply adjusting the call or the put strike. What I haven't mentioned here is I just said buy stock, sell call, buy put. That's just a standard, straightforward definition of a collar. Well, I can choose to sell the call in the money, at the money, or out of the money. I can sell it 1 month out, 2 months out, or 3 months out. I can buy the put in the money. I can buy the put out of the money, or I can buy the put at the money. Depending on what my market sentiment is and what I want to see going forward will determine what type of setup I use. Even with going long stock, selling a call and buying a put, I can create a long collar spread that's bullish, bearish, or neutral. Now, the reverse form of the collar spread, of course, is what's called the short collar. I should say the reverse form of the long collar is what's referred to as a short collar. In a short collar position, I'm going to sell or short the stock, sell a put, and buy a call. Okay? Now, again, I didn't mention what strike I'm selling the put at, if it's at, out, or in the money. I didn't mention what strike that I was buying the call at, if it was at, out, or in the money. Again, depending on how I set up the strikes, which range I go, I can use a short collar to be bearish, to be bullish, or to be neutral. This is the variety and the dynamics that collar spreads give to us. Okay? All right. Now, let's take a look at the standard or long collar, and we're going to look at what's typically called a standard collar. The action, again, we're going to buy stock, sell a call, which obligates us to deliver shares of stock at a set strike price, and buy a put, which guarantees us a limited loss. The most common form is a standard collar, where I'd buy stock, let's say I buy shares of stock at XYZ for $50. At the same time, I might sell an at or out of the money call. So I might sell the $50 call or the $52.50 call, depending on what my sentiment is and how bullish I am at the stock, preferably 1 month out in time or less than 45 days out in time. I'm going to keep it in the near-term month. At the same time, I'm going to purchase an out-of-the-money put. Okay, so I might buy stock at 50, Let's say I sell the 50 call, and at the same time, I might buy a 45 put. And I'm going to have the call and the put with the same expiration month. So right now, I'd be using the November expiration, and we're going to take a look at that in just one moment. Okay? The sentiment of a standard long collar is bullish to neutral. We expect the stock to rise gradually in price over the next 30 days. Now, profit is earned if the stock is trading above the call strike price. We'll get assigned, deliver our shares of stock, and that's going to be our maximum profit. Profit can be achieved if the stock is between the two strike prices and above the break-even price. Okay? So even if the stock stays neutral, moves up slightly, we still might be able to have a small profit on the position. We won't get assigned both the call and the put would expire worthless, and then we can enter a new position for the next month on the shares of stock that we still own. If we are wrong on our sentiment and the stock drops, our losses are limited, especially in the event of a major unforeseen event or a major decline. Okay, we can protect ourselves to only take on a 3, 4, or 5% risk on a collar position. This allows us to stay in the game longer, not risk a lot of capital that's in our portfolio. Okay? Now, as I mentioned, we're expecting a slight increase in the stock price, not a major move. If I'm expecting a major move in the stock price, well, we're going to use a different option strategy potentially to take advantage of that. You know, we might do a more speculative position, or we might do a different form of a married put that would give us limited risk, but still have unlimited upside profit potential. This is kind of what Kurt Frankenberg teaches over at Radioactive Trading. Okay, so if I expected a major move, I'm going to be doing a different position. This is more for expecting a gradual move over the course of maybe the next 30 to 60 days, the standard collar. Now, as we just touched upon, what are the possibilities? Well, if the stock moves above the call strike price at expiration, the put expires, we have to deliver our shares of stock at the call strike price, and this gives us the maximum profit potential for that position. If the stock is between the call and the put strike, both the call and the put will expire worthless, and the stock is still owned. This can be a slight profit or a slight loss depending on what our break-even is. Okay? Now, if the stock drops below the put strike price at expiration, the call expires worthless. We can exercise the put to close the stock at the put strike price, which results in the maximum loss. Another thing we'll discuss next week in the management is we could also simply sell to close that put option for whatever intrinsic value it has and still hold the stock if we expect it to increase in price in the near future. Okay? Now let's take a look at a general standard collar example. We ran this search this morning right before the market opens, and this is the position that we found on Research in Motion. Okay? Research in Motion was trading at $68.25 per share. Okay? My sentiment on RIMM, this isn't actual, but let's say that my sentiment on Research in Motion is it's going to move up gradually over the next 30 to 45 days through November expiration. One way I can enter a protective position to profit on this, earn a good monthly return, but still have limited risk, is I can buy the shares of RIMM right now at $68.25. I can sell the November 70 call for $3.10. So I'm going to collect $3.10 of premium against the stock purchase. At the same time, I'm going to buy a November 65 put. This is below the current stock price, so it's out of the money. And the price for the November 65 put was $2.35. So between the two options, $3.10 and $6.35, this generates a generates a credit for me of about 75 cents. Okay? But the total net debit of the position, my long stock minus my call premium plus the put premium, is $67.50. My goal is that I think the stock's going to move up above 70 within the next 35 to 45 days through November expiration. Remember, if that happens, I'm going to get assigned at $70 per share. So my maximum profit here is $2.50. Okay, that's the most I can make on the position. It is a limited gain position. And that will occur if the stock's trading above $70 at expiration. The maximum loss that I can have on this position is $2.50, or about 3.7% as well. This position actually just turned out to be even on both sides, believe it or not. So if the stock drops below the put strike price, I was wrong in my sentiment, and the stock drops below $65 per share, I'll have a maximum loss of $2.50, or in this case, a total loss of $250 off a $6,750 investment. Okay? So Let's take a look at this graphically. Here's what we're looking at as we enter the position and heading into November expiration. Okay, the stock's below 65. It's trading below here on November expiration. We're going to have our maximum loss of $250. If the stock does as we hoped and it goes above $70 per share, we'll make $250. We'll get assigned. We'll have to deliver our shares of stock at 70, remember. The put option will expire worthless, won't have any value, and we'll make 3.7%. Now, if the stock is trading anywhere above this break-even price, we can still make a profit. So let's say the stock's trading at around $67 per share. We'll still have a small profit of maybe $100 or $105. This is basically generated from the premium we collected, which countered some of the drop in the stock price. Again, if the stock's trading below the break-even price but above 65, we'll still have a loss, but it won't be the maximum loss. We'll still have a limited loss on the position. Now, some of you who are experienced options traders will take a look at this and say, okay, well, that's a bull spread, isn't it? That looks like the same thing as a bull call debit spread or a bull put credit spread. Well, remember, we discussed that. We're going to discuss that in a moment. I'm sorry. We discussed that in the beginning of the presentation. They are parity trades to a collar spread. But before we go further into the parity trade discussion, let's go ahead and link back over now to PowerOptions. We're going to take a look at this position a little bit more in depth on the PowerOptions portfolio. And here we are on the PowerOptions portfolio tool, the profit and loss portfolio. And the bottom position I have down here is that research in motion spread that we just looked at, the collar spread we just reviewed. Here's our stock initial price at $68.25, the call premium we sold for $310, and here's our put purchase price at $235. Now, this portfolio tool is a very powerful tool for tracking and managing your options positions. One of the things that I find extremely useful about this tool is notice on the top header bar of each section, it's labeled by strategy. It's not going to work for me. Let me go ahead and do this. Sorry about that. So here we see we have one bull put credit spread, one calendar call spread, and two collars. So sometimes in my broker's account, when I look at my trades, I may have 3 or 4 stock position open, and then underneath that I have 3 short calls listed, but they're not linked to the stocks. One of the benefits of the PowerOptions portfolio is everything is linked by strategy. But once I'm tracking a position in the portfolio tool, the first thing I can do to analyze what-if scenarios, we want to see what might happen with this collar position, is I can use these more information buttons. I'm going to link to position actions here, and I'm just going to go into the profit and loss chart. Now this is going to appear similar to what we were just viewing on the slide. However, we can do a little bit more interaction now that we're in the profit and loss chart here. Okay? So here we see that we have our position spelled out for us up at the top in the trade details section. Beneath here we have our break-even price, which in the case of a standard collar is equal to our net debit. We're shown our maximum risk and our maximum profit at expiration. Again, the maximum risk occurs if we're below $65 per share as shown on the chart, and our maximum return will be earned if the stock is trading above $70 on November expiration. Now, if I wanted to know what my position might look like if the stock was trading, let's say, at $69 on October 30th or October 31st, I can just simply plug that into the field, and then I'll go ahead and hit calculate. See, I put in a price of $69. Here's a selected date of 10/30, and now down below, it recalculated for me what my expected gain or loss would be on the total position. I'd have a $75 gain on the stock. I'd have a $92 gain on the call, and a loss of about $126 on the put option because the stock moved up in price. This would give me an overall gain of about $41. And let's say I wanted to know what would happen if the stock dropped a little bit. Let's say we wanted to know if the stock dropped down to $66 on, let's just take next Thursday. What's going to happen to this position theoretically if our stock drops to $66 on October 15th? Well, I'll plug that in and run calculate again. Here we see now we have a $225 loss on the stock. We'd have a $136 gain on our call. We sold it for $310, and if the stock was trading at $66 on October 15th, we'd have a gain of about $136 because the call would drop in price. At the same time, we have a gain in the put option, but we see down here at our total expected profit and loss, we'd have a small loss on the position. So this tool, once you're tracking it in the portfolio tool, is going to greatly help you analyze your what-if scenarios. And even before you enter this position, once you find it on the, I should say, identify potential trades using the search tool, which we're going to take a look at in a little bit, before you place the trade, you'll be able to link to this tool as well so that you can see the what-if scenarios there before you place the trade. Okay? Now let's go back to our slide there. And we're going to talk briefly about the parity to the standard collar. I had mentioned that. We just looked at the profit and loss chart for the collar spread. And now we're going to go ahead and take a look at what I was referring to about the bull put credit spread. Now the parity to the standard collar, bull put credit spread, also a bull call debit spread is a parity trade as well. We're not going to talk about the bull call debit spread tonight. We're just going to take a look at the bull put credit spread. In a bull put credit spread, what I'm going to do is sell an at or out of the money put option against the stock that I'm neutral to bullish on. At the same time, we're going to buy a deeper out of the money put option for the same expiration date as the put that we sold. Because the put option that we sold is closer to the current stock price, we're going to receive a higher premium for that option. This is going to result in a net credit for the position, and the risk on the position is the difference in the strike prices. Okay? So when we looked at our original RIMM position, we were going to buy stock at about 68.25. We were going to sell the November 70 call option and buy the November 65 put option. Here we're going to use the same put option, but we're going to sell to open the November 70 put at $4.75. That's going to be pulled into our account. At the same time, we're going to buy to open that November 65 put at $2.25. The maximum profit is the net credit we receive, the difference between the two options, which is $2.50. Okay? The maximum risk for the position is defined again as the difference in strike prices minus the net credit. So the most we can lose on this position is $2.50. Okay? Now, depending on your broker, that may be true or not true. What I'm used to seeing with some of the brokers that I've reviewed is that if I sold this spread with a 5-point difference in the strike prices and I collected a credit of $2.50, my broker is going to require me to have on hold in my account, I should say, $2.50 times the number of contracts times 100 for everything that for the position that I've entered. Okay? Some brokers will not do that. Some brokers will charge you the whole difference in the strike prices, the 5 points between the different strike prices, to place this trade. Okay, it is a leverage trade, and we're going to have to point that out because that's going to be very important coming up in the next slide. Okay, so depending on what your broker requires, your margin requirement for this trade might be $2.50 per contract or $5 per contract. Okay, so here's the profit and loss chart for that bull put credit spread on RIMM. And no, I did not get lazy and simply copy the previous profit and loss chart. This is the same exact position. They're parity trades, but there is a difference that you have to watch out for. When I'm looking to enter a collar spread, I will compare it to the parity trade of the bull put credit spread, but I have to keep in mind certain things that may get me into trouble. Okay? There may be a disparity there too, by the way. The reason why I check that is if I went over to the bull put credit spread and I was shown that I could receive a net credit of $2.70 and only risk $2.30, that spread might be more appealing to me. However, in this situation, let's talk about if it's an advantage to use the bull put credit spread over a standard collar or not. Well, as we saw with both positions, we have the same monetary profit if the same scenario happened. In both positions, if the stock was trading above $70 per share, we'd make the maximum profit. For the collar spread, the put would expire worthless, we'd get assigned on the 70 strike call, and receive the maximum profit of $2.50. On the parity trade bull put credit spread, if the stock's trading above $70 per share, both puts expire worthless, and we'd keep the $2.50 net credit. So the same monetary profit. We also have the same monetary risk. Remember, we were only risking $2.50 on the standard collar if the stock ended up trading below $65 per share at expiration. And we had that same risk if we use the margin there, the difference in strike prices minus the net credit. We have the same risk on the bull put credit spread. Now, with the standard collar position, I have to buy stock, and I'm putting out about $6,750 to enter the trade. On the bull put credit spread, I'm looking to earn $2.50 on either a 250 risk or a 5-point risk, again, depending on my broker. So the bull put percentage return is much higher, but it's leverage. On the collar, we have to own stock. On the bull put credit spread, we do not need to own stock. And another difference between the two is depending on how your broker allows you to enter trade, collar spread is technically 3 transactions. You have to buy the stock, sell the call, and buy the puts. You might have 3 commission fees. But you may be able to leg into a collar by entering it as a covered call with a long put, so you'd only have 2 commissions. And some brokers will even allow you to enter this as a 3-legged trade as a spread position where you just might pay a spread commission of $20, $19.95, for example. Now, a bull put credit spread initially may only have 2 commissions, but if you have a broker that allows you to enter a spread commission for a reduced rate, then it might only be that one reduced rate as well. So those are some of the differences. But when we compare the parity trades, we always have to compare with caution. Collars, bull puts, bull calls, remember, they're all parity trades of one another, but we have to be wary of leverage. Okay? Let's say that we had $10,000 to invest in a position. We've got $10,000 of free capital. We're interested in investing in RIMM. We think it's going to have a gradual move up over the next 35 to 45 days. Now, in a collar trade, the most we would be able to do right now is 100 shares and 1 contract of the call and the put. Okay, we're not going to trade on margin. We're just assuming that we're putting the full amount into the position. And that would cost us 100 shares. That would be a cost of $6,750. We couldn't do 200 shares because that would put us over $13,000. We don't have that. We're going to invest $10,000. So with investing in a collar with 100 shares, the most we could lose is that $2.50 times the $202.50 per contract or per share, or $250. That's the maximum risk we can take on the position. Now, a bull put is a leveraged trade. Okay? So when you look at a bull put, say, okay, I have $10,000 to invest. If my broker is going to charge me the full amount, the difference in strike prices of $5,000, I can trade 20 contracts. But you know what? If they're giving me that difference between the net credit and the difference in the strike prices, I can trade 40 contracts, which would be a maximum risk of $10,000. Okay? So just because you have the money to invest in it, never put that all into a leveraged trade. Only trade which you can afford to risk and what you feel is comfortable to risk for your portfolio. Let's say that with this $10,000 free capital, if my total portfolio amount was $50,000 and I was looking to invest $10,000 into research in motion, if I took on a bull put credit spread that had a risk of $5,000, that's 10% of my total portfolio value. That's way too much to put into one position. The $250, that's only it's only about 0.5%. I can lose that if I'm wrong and still have a lot of money left over to keep managing the trade. So if you do decide to go with a bull put credit spread over a standard collar trade, remember, only trade what you can afford to risk. Don't over leverage yourself. The great thing about married put positions and collars is that it emphasizes proper position sizing and correct money management. Yes, they are parity trades. Yes, they have the same profit and loss chart. But if you trade them the wrong way, if you over-leverage yourself, they no longer act the same, and you can get yourself caught into a very bad position. Okay? All right. Now, I'm sorry. Went a little bit too far there. Hold on one second. There we go. Okay, let's talk a little bit briefly about other collar forms. Okay, I have a question that just popped in from Orlando. I want to address this real quick. Would I only do the standard collar on stocks that I'm assuming that he means that I didn't get the sentence correctly, but do I only want to trade the standard collars on stocks I'm hoping to get assigned on and maybe earn a monthly return? I think that's what you're asking, Orlando, and the answer is yes. That's why I use standard collars. The last 3 or 4 months have been very good for this type of strategy. Even on the times when it was wrong, when the market dipped, I was only risking a 3 or 4% amount on the standard collar positions, unlike a covered call trade where I still had almost unlimited risk on the downside. Okay? So, yes, I was not married to the stock, for lack of a better term. I was hoping to have it get assigned, take my 2.5 or 3% return, take that capital, and then move into another position. But let's talk about, that was a good lead-in, and that's why I wanted to take that question right now, because what we're looking at here is what are some of the other forms. One of the general rules of options is that options that are 6 months out in time are not going to be 6 times the price. As I go further to expiration date, if I look at options that are out to January 2011, even now January 2012, or I look out to March or April, for example, the options that are further out in time do not have a linear increase in price. So if I was going to be trading RIMM for a longer extended period of time and I was trying to generate income now, instead of buying the November 65 put, maybe I can go further out in time and look at the March 2010 65 put. Let's take a look at it. In that original standard collar position, the November 65 put had 44 days to expiration, and it had a cost of about $235. The 2010 March 65 put, same strike, but 163 days out in time. Okay, almost 4 times the range out in time. An extra 3 months out in time, for example, was only $6.65. So we're about 4 times the days out to expiration, but we're not near 4 times the cost. Okay, if you talk to any options investor who's been trading, they'll tell you that when you're selling positions, when you're selling premium, either in a covered call, naked put, credit spread, you want to sell short term. You want to keep those positions 35 to 40 days out in time. And then if I'm buying an option, if I'm speculating by buying a call or buying a put, I want to buy farther out in time, first to give the stock more time to go in the direction that I want to, and B, because I'm paying less per day. Yes, the initial price up front is more, but the average time per day is going to be much lower, okay, because it's not a linear increase in time. So another way I could approach this, and what we refer to as an extended collar, is we could buy 100 shares of RIMM again at $68.25, sell the November 70 call for $310, and buy the 2010 March 65 put for $665. This now makes my total net debit at $71.80. I have a maximum profit of $317 or 4.4%, with a side note that we're going to get to in a second, and I have a potential maximum loss of $6.81 or 9.5%, again, which we're going to address in just one moment. Okay? Now, the higher risk, of course, is due to the higher put cost. We paid more money into that put option, so our net debit is higher, and the insurance policy does not kick in until the stock drops below $65 per share. The maximum return we just saw is only achieved if the stock is trading right at the call strike price at November expiration. Okay? Let me go ahead and take a look here. Let's go back to the PowerOptions tools. I want to show this position here. We want to take a look at that profit and loss chart. Here's the extended caller position we just referred to. There's our November 70 call, and then we added the March 2010 65 put option against it instead of using the November. Okay, so we're going to click that More Information button, and now we're going to go to the profit and loss chart, and let's take a look at what this extended collar position would look like. Now, this is our profit and loss at November expiration. Some of you may have read forward on that slide when I was referring to, are there any calendar spread traders? This, although this is a collar spread, this has an identical profit and loss chart to what's known as a diagonal calendar call spread, okay, where I might buy an in-the-money call and then far out in time, and then sell an at or out-of-the-money short-term call against it. Okay? Again, here's our maximum risk of 9.5%. Again, that's calculated at November expiration. If the stock was trading at $0 on November expiration, where our short-term expires, that's the maximum risk. The percentage return occurs only there and right there. If the stock continues to move up and it goes above 70 before November expiration, it's trading, let's say, at 75 on November expiration, we're not going to have as high a profit, because as the stock increases, our call automatically, once it goes in the money, that call automatically goes to a delta of 1 on the expiration date. Our put is losing value, and we've capped the gain in our stock by having a short call against it. It might be better in these situations when you're looking, if this is your sentiment, you think the stock might be trading right around 70 and you're looking to make this profit, you might be better off, instead of using a collar, using, as I mentioned, the diagonal calendar spread. Okay, we can take a look at that in a second too. I have that back in the portfolio. But just as we just discussed with the bull put credit spread compared to the standard collar, I tell you what, before you do decide to just go with the calendar spread, remember, you can over-leverage yourself. You can trade too many calls and sell too many calls against it. And if you put in the same amount of money into a diagonal calendar spread that you were going to put into a collar, you're going to have a much higher monetary risk that you probably shouldn't take in your portfolio. So always, again, I'm just going to reiterate this, and these are terms that I learned from Kurt Frankenberg over at Radioactive Trading. You know, proper management, proper position sizing, and focus on risk management. Never risk more in a position that you can afford to lose, no matter how confident you are that the stock's going to move up or how confident you are in your assumption that the stock's going to be trading right around a certain stock price on a specific date. Okay, it's very important. If you take nothing else away from these presentations, and if you've ever joined Kurt and I for our presentations for Radioactive Trading, Tuesday and Thursdays at noon, that's one of the most important things you could ever learn. Force yourself to take proper position sizing. Never risk more than you can afford to risk. Okay? Just for a quick analysis here, here's that calendar spread I was referring to. We could buy the 2010 March 65 call for around $10.05 per share. At the same time, sell the November 70 call that we were looking at for $3.10. And if I link quickly over to the profit and loss chart for that calendar spread, this diagonal spread here, that's going to look exactly the same to the position that we were just reviewing. Okay, there it is. This is not the same graph. This is the calendar spread. You see the percentage return is increased because of the leverage. But if I put the same $10,000 into this position, I'd be risking more than I would probably want to in my portfolio, as opposed to the collar spread, which gives me that proper position sizing aspects. Okay? All right, let's go ahead and shut that down for now. Let's go ahead back to our slides here. Let's move on to the next position, okay? Now, what do we want to look for when entering in a collar position? We're going to review a couple more slides, and I'm going to go into the search tool on PowerOptions, our patented search tool, and we're going to discuss some of the features there and some of the different forms of collar spreads, okay? So what to look for? It depends on your market sentiment. You're going to be able to use the various default searches on PowerOptions that Ernie and I created as a guide. The default searches are not recommendations, nor are they suggestions of what you should be trading. We've put together a default criteria set to find positions on what one would generally look for on the different collar spreads, but you want to adjust the criteria to find only those positions that match your personal risk-reward tolerance. Adjust the stock criteria to find bullish or bearish positions, depending on which sentiment we're taking. Adjust the percentage return and the maximum risk levels to match your personal tolerance, your personal threshold. You can adjust the ranges in the money and out of the money on the calls and puts based on what you want to see. Or, once you've done that, you can quickly compare it to the parity trades. But again, we want to beware of leverage. Okay? Now, with that introduction, let me go back into PowerOptions. We're going to go ahead here on the main PowerOptions navigation menu. We're in the portfolio tool right now where we're tracking and managing these positions. If I want to access the tools for a collar, I'll just go ahead and click on the collar menu. This is for long collars, okay? The short collar tab I have selected right next to it. If you don't see long collar or short collar on your available tabs and you're interested in trading those positions, simply click on the Other Strategies tab, and then you can be able to select which of the 23 strategies you want to view that we support in the available 8 fields up at the top. Okay? So when I want to access the search tool in a given strategy, I'll go ahead and click on collar, and now I'm going to go ahead and click on the search tool. I recommend using the search tool. There is a section in every strategy for sample searches, but I don't want to go too deep into those right now, okay? Because Ernie and I have put a lot of attention into the positions that are used here in the standard collar, in the main search tool, for each of the individual types of collar spreads that can be used. And there may be more. We didn't add every one of them due to the fact that some of those might offer too much risk. Okay? And what I did is I do apologize, I had to quickly change it to the default search here that's called Initial Values at the Money. Okay, right down here at the bottom, this is the search when you first log on to PowerOptions. You go into the collar spread. This is the first default search that will appear. This is looking at the standard collars that we were talking about earlier. Okay. Now the prices are a little bit different, but take a look. This morning is when I looked to enter that research in motion trade. Well, it's still available. Okay, it's $68.66 there. There's our November 70 call, still priced at $3.10, but the November 65 call is actually at a different price. It's at $2.19. So we can maybe get a little bit more kick out of this position possibly. Again, please do not think that I am recommending research in motion. I just use this as a basis for the analysis in this presentation. Okay? All right. So the positions that we found here, you see that most of these on the top, we're sorting it by the lowest maximum risk to the highest. Okay, so this column right here, our maximum risk, you see that there are several positions that are available that have a risk under 5% where we can still achieve a potential return of 3.5%, 3.7%. There's one for 4%, 3.5% again. So this is a kind of position where we're looking at making a decent monthly return, but we're limiting our risk. Again, as Orlando asked me earlier, and I kind of mentioned, yes, when I enter into a collar position such as this, a standard collar, I'm expecting to get assigned in the next month. Why am I not doing a covered call? Well, because I'm not comfortable in these uncertain markets. I'm willing to give up some of my potential return on the standard covered call trade or the slightly out of the money call trade to be able to have some protection. Now, I'm not going to go into a discussion. I know some questions are going to come up at the end. I know a lot of the people, a lot of the attendees online tonight are covered call traders. They're going to come out and they're going to mention to me that, Mike, you know better than anyone, if you go a little bit in the money, instead of selling the 70 call in research in motion that's out of the money, if you sold the 65 call, you still might be able to make that 2.5%, 3% return and still have a good downside protection of 7, 8, or maybe even 9%. Well, that's true. But what happens in an earnings season if research in motion dips in the pre or after market hours beyond that downside protection of 7, 8, or 9%? Maybe it has a drop of 15%. Maybe it has a drop of 20%. Can I afford to take that on a risky position? Well, no. And of course, if I was doing that anyway, as many many of you guys I've talked to in the past who are trading covered calls, you'll tell me, well, Mike, we know you better than that. You don't trade covered calls or naked puts or credit spreads when there's an earnings coming up between now and expiration. Okay? But this is a personal preference. If we want to talk later on at another time about covered calls and how they can be used, we will do that. Probably later on this month, we're going to have a series of presentations on that as well. But I prefer to use the collar spreads when I'm hoping to get assigned but still have a limited risk. All right. Now, let's take a look at the parameters below. This might seem very daunting at first, even for some of you who have traded, you've been using PowerOptions, I should say, in the past, but now that, excuse me, I had to take a quick drink there. Even though those of you who've used PowerOptions, it's a little bit trickier now when we're looking at these positions because we have to combine both the call and the put together. So to start, you see that we've left the expiration time frame on the same. This is on the initial value search, okay? We've left that time frame the same. We're forcing the positions. Here we can set the standard for what we want to be the short call out of the money and what we want the long put to be out of the money as well, okay? So that allows us to bracket the stock price. The center section on any strategy in PowerOptions, our center section here is essentially designated for the option and the return information. So I can set the limit for my percent maximum risk, my monetary maximum risk, I should say, or my percentage maximum risk. I can set the range for the percent assigned I want to see on the standard collar position. If I want to have a certain call premium or a net premium as well, I can set that. We can screen specifically for liquidity, open interest, or option volume. Okay? Now remember, when we looked at that profit and loss chart, the standard collar that we're looking at right now is a neutral to bullish position. Okay? So here I can put in ranges. I have ranges set in for the default search for earnings per share growth and price per earnings. I'm only looking for stocks that are trading above, I'm sorry. Let me start over again. I'm only looking for a position, a stock that has at least 5% earnings growth from last year to this year. And I'm only looking for a basic PE ratio of 0 to 70. But I can put in several different criteria here. If I wanted to look for average broker recommendation, shares outstanding, for example, average stock volume or price per sales. If I wanted to limit the historical volatility, I could do that as well. You also have technical screens for RSI and Bollinger Bands. And let's scroll further down. We also have a field here where you can select to screen against stocks that are trading in a certain moving average. Typically what I might do in one of these types of positions is I'll look for stocks that might be trading above their 50-day moving average. Okay? It's just the personal preference. Another thing that we can use that I just mentioned, if you wanted to, you could specifically check to look for stocks that do not have an earnings date between now and expiration. Okay, so there's a multitude of criteria you can use to screen against for both the stock and the option to find only those positions that you want to see. But you want to start off using one of these defaults here as a stepping stone to create your own personal search. Now let's review some of the other default searches we have here real quick, okay? In addition to this position, the initial value set, one of the other forms we talked about was the different months standard collar. Remember where we were looking at the RIMM position but buying the March 2010 65 put instead of the November. Okay, so this particular screen, this different month standard collar form, will allow you to look for out-of-the-money put options that are far out in time and still sell the short-term call against it. Remember what that profit and loss chart looked like. It was more like a diagonal calendar spread. Okay, so what you're assuming in the first month is the stocks will be trading right around that short-term strike price. This is a more aggressive form of trading this type of strategy. Okay, another situation that you can use is the one called debit collars. Until you get really familiar with collars, I wouldn't recommend doing this. This particular one, you're buying an in-the-money put that's 1 month out in time. Okay, so here we have CSX, stocks trading at 44.13. I'm going to sell a deep out-of-the-money November 49 call for 95 cents and buy the in-the-money November 47 put for about 4.50. I pay a debit to get into this position, and so we see here that the total debit for the position, the break-even is $47.68. But since you've bought an in-the-money put option, you have a low risk of only 1.4%, but you have an extremely low percent return if assigned as well, and a very low probability of making it. We added this into the default search because we had a couple of customers who were trading the specific style and requested a default search be put into the system. This isn't something that I recommend doing. Let's take a look at the profit and loss chart and you'll see why. Okay, so I'm just going to take that first position, the CSX position we were just looking at, and here's the collar. It's not even shown on the full page because in order to get this full profit of 2.8%, the stock has to be trading well above $49. It has to be trading above $49 per share, above the call price that we sold. Okay, this is a position that you're extremely bullish on. You expect the stock to move up very quickly. It's not a smart position to trade. Again, we have it in there in the default because customers, a couple of customers requested it who trade a specific methodology. But I don't advise that you enter into this type of trade. And when you take a look at the profit and loss chart, you'd probably recognize right away that that's a trade you would not want to enter. Okay? Something I'm very fond of, and I want to explain why. There is a term called a reversal trade. Here we see that there's a conversion. Okay, let me explain a conversion real quick. I'm going to pull it up real quick and let's talk about a conversion. A conversion is essentially a limited risk trade. Essentially, it has no risk. It's almost a guaranteed profit if you can find the disparity between a call strike and a put strike. What we're going to do is we're going to do the same type of setup as a caller. We're going to buy stock. We can buy this stock at $3.34 per share. We can then go ahead and sell the November 3 strike call for 75 cents, and we're going to buy the same strike, same month expiration put, and here it's only cost 40 cents. Well, wait a minute. We're going to receive a net credit of 35 cents, or net premium 35 cents, and our break even is $2.99. But if the stock's trading above $3 per share, we get assigned, and if the stock's trading below $3 per share, we can exercise our put. So we have a maximum risk of negative 1 cent, or a guaranteed return of a penny, or 0.3%. Let's take a look at the profit and loss chart. This is going to be a straight line. Okay, this is what a conversion is. Oh, whoa, wrong link. I apologize for that, ladies and gentlemen. Let me go to that profit and loss chart there. There we go. Okay, so this red line is showing us the halfway point, what we could expect to make on the position on 10/30 if the stock was trading at a certain price. Okay, but the blue line, this is our expiration. If we did 100 shares, we're guaranteed $1 of profit. Does that make sense? Absolutely not, because remember, if we have a more restricted broker, we're going to have to pay 3 commission costs to get into this position. So even if my commissions are $5 per stock, 100 shares of stock, and $5 per contract, that's $15. Now I'm at a guaranteed loss of $14. Conversion spreads exist, but they're typically only used by floor traders or people with very large accounts. Okay, it's not reasonable. It doesn't make sense for us to trade a conversion. Now, the reversal of a conversion in the short collars, which we're not going to get into tonight too much, we'll just be aware that there is a short collar where we short the stock, sell the put, and buy a call. The reverse of a conversion that we're looking at right now is called a reversal, where I'm going to short the stock, sell the put, and buy the call at the same price, and we'll see that same kind of straight line. Again, this is not for retail investors, but we've put it up there to help you get started if you wanted to look for these types of trades. Okay? The reason why I mention that first is because I've created something here called a reversal collar search same month. Okay? And what I like to use this for is the reversal collar. What we're doing here is I'm going to sort of take the reverse of a standard collar format that we were looking at earlier. Here, I might buy a stock. Here's U.S. Steel Group at 44.12. I'm going to sell the slightly at or out of the money November 45 call for about $3 per share. And at the same time, I'm going to buy a November 48 put option. It's almost $4 in the money. Okay, and it's above the put strike for $5.80. Now I have a maximum risk of 4% and a potential percent if assigned of 4.2%. But this is not a bullish position. I'm long stock, sold a call, and bought a put, but this is actually a bearish position. Let's take a look at the profit and loss chart. Okay, what happened here? Now we see something interesting. We make our profit, the maximum profit on this position, if the stock's trading below $45, and the maximum risk on the position is if the stock's trading above 48. Well, how is that possible? We did the same thing that we did in the standard collar. We bought stock, sold a call, went long a put. But you know what? Here's what had happened. We bought an in-the-money put for a higher premium of $5.80. We're actually paying a debit, a premium debit of about $2.80 between the call premium we receive and the price of the put option. Okay, so this lowers our cost basis down to $46.92. But what do we own? We own a November 48 put. So our cost in the position is $46.92. But if the stock stays below that, if the stock is below $45 per share, the call expires worthless, so we don't have an obligation, and we can exercise our put to sell our shares of stock for $48, and that gives us the maximum profit. The difference between the $46.92 and the put guarantee price of $48, that's our maximum profit. The risk occurs if the stock moves up above 48. In that scenario, our put would expire worthless. Our put would expire worthless. The stock's trading at $49, but you know what? We've obligated ourselves to deliver shares of stock at $45 per share on a net debit of $46.92. Those of you who are experienced options traders, again, you're going to take a look at this and say, that's just a bear call credit spread. No one would do this reverse collar in this fashion. They would just do a bear call credit spread. Well, to answer your questions, I do these types of reverse collars, and the reason why I do them is because I have a retirement account at Fidelity, and because of the restrictions of the Fidelity account, I'm not allowed to trade credit or debit spreads. So if I'm in a bearish market and I don't want to be long stocks, and I have some other radioactive trades that I'm protected and I can adjust using Kurt's income methods, okay, we're going to talk about that in a little bit too. But in this scenario, I don't want to buy a put because that's too speculative. I can, even if the market doesn't do what I want to, even if it's bearish, if it doesn't move down far enough, I can lose money. I can't trade a credit spread or a debit spread, and I can't short stock. So I use this form of a bearish collar to mimic a bear call credit spread return in an account that I can't trade credit spreads on because I can get a better probability of having success on this trade. Now, I think Ernie answered a question that came through a little while ago, and I didn't get a chance to review it before Ernie answered the question, but someone had popped in when we were looking back at the search tool. And I might just go back there for 1 second very quickly here. Let me just go back into our search tool. Okay, and I'm going to go back to that standard collar, the initial value standard collar screen. Okay, and we're going to take a look at the far right-hand column, the probabilities. I had mentioned earlier in response to Orlando's question that these types of collar positions that I'm looking at, I am potentially expecting to get assigned on and make that return. Okay, I expect the stock to move gradually up. When I do my research and analysis on the position, I'm going to expect the stock to move gradually up in price and that's what I'm looking to achieve. True, I only have a 44% probability in this case that the stock's going to be trading above $70 on November expiration. There is, of course, a specific reason why I picked Research in Motion, okay? And that reason is Research in Motion is a more volatile stock. Here I can see that we can enter a collar position on Research in Motion where I might make a 3.3% if assigned, but I'm only risking 4.1% in the next 44 days. What do we know about Research in Motion and the time frame that we're in? In order to do that, let's go into some of the analysis tools that we can quickly link to using that More Information button. I'm going to go to Research, and I'm going to go to Stock Detail. Okay? And here, what we see is that we don't have a dividend date, and the earnings date actually is on 12/17. Okay, so it's actually after the earnings date. But what is the market going, I'm sorry, the November call that we sold, this collar position expires before the earnings date. But what season are we in? We are still in an earnings season. And what that means is that, excuse me, what that means is that the market's going to be fluctuating up and down in reaction to the earnings that are coming out and, of course, any further job reports that comes out. We've all been watching the market for the past 2 or 3 months. We know how this is going to go. So although I am expecting to get assigned, and yes, it has a low probability there of being assigned of only 44% or so, but again, this would be a position I'm expecting to grow. I'm expecting the market to be volatile, and I'm not taking on that much risk. And at the same time, I can maneuver the position if I want to extend it out further by adjusting the call or the put. Now, if you wanted to have a higher probability, all I have to do is scroll down to the bottom, and I just have to find that probability assigned column for the call, and let's just change it. Let's say I wanted to have a higher probability of 65% that I'd get assigned on the short call. I'm pretty sure I know what's going to happen here, but I'm going to try it anyway, okay? So now I'm going to adjust the system, and with one click, I'm going to tell it to only find me those positions that match my criteria but have a 65% probability of being assigned. What happened? No stock options match my combination. Why? Well, when I go deeper in the money on that short call, and I give up some intrinsic value premium, and I'm buying a further out of the money put, I'm not going to be able to achieve the potential percent assigned that if I want that I programmed into the tool, and I might be taking on more risk, actually. I might have a higher maximum risk with that put further out of the money. Okay, so it no longer matches my requirements for percent if assigned or percentage maximum risk. If I wanted to go deeper in the money on my short call or just at the money or slightly below it to have a higher higher probability of getting assigned, I would have to adjust my other columns in order to achieve that. Okay, it all works hand in hand. We can't expect to go into a certain position expecting a 75% probability of being assigned, an 8% return, and a less than 4% risk. If we could all find positions that did that, everyone would be trading options, and we'd have them programmed in the system so you could find those all day long. Okay? All right. Okay, so those are some of the features. Those are some of the different types of collars you can build. What I want everyone to do, even if you don't have a 14-day free trial to PowerOptions, you want to go to PowerOp.com, sign up for the free 14-day free trial, go into the collar tool, go into the search here and play around with some of those searches so you can see the different forms of collars there. Take a look at the profit and loss charts so that you can see whether it's bullish or bearish. Okay, I'm going to link right back to our slideshow here. I just wanted to remind everyone, okay, the tracking position and managements of these we're going to discuss next week, October 15th at 6 p.m. Eastern Time. I'm going to leave those collar positions that we saw in the portfolio tonight, the 2 RIMM positions. I'm also going to show leave the bull put and the calendar spread parity trade position in there. We're actually going to see what those look like a week from now after our entry price. Okay, we're going to do a little bit more follow-up on today's presentations, review the portfolio tools next week at October 15th. We're also going to discuss some of the management techniques on the different collars, okay? Later on this week, possibly on the weekend, you're going to be receiving a recap email from me later on about what we talked about tonight. And we've also, in the Power Forum on PowerOptions, I'll show you where that is in just one moment, we've also created a thread for the collar discussions, okay? So we want to go on there, put in your feedback, whether you want to talk about the presentation tonight or want to talk about what's coming up next week. Please feel free to post there in the Power Forum, and we'll be showcasing that in a minute. Now, after this presentation, full details of the various collars we've talked about tonight and married puts is available in the Protective Options Strategies book, which I mentioned was written by Ernie Zrenner and myself. It's a low cost. It's only about $20. It's loaded with information not only on the strategies and when to use them and the management techniques, but also on using the tools on Power Options. And you can locate this book right in the Power Store. Okay? You've heard me mention a couple names this evening, such as Kurt Frankenberg and radioactive trading. Okay? Radioactive trading takes advantage of a unique form of a married put position, and then he applies 10 different income methods to it. He does add a call to it in an income method number 1, what he refers to as income method number 1, to create a certain form of collar. But the radioactive trading methodology, as described in the blueprint, is a full trading methodology. This methodology that Kurt developed is more conservative than trading the short-term collars that we're talking about tonight. As I believe, I can't remember who had mentioned it before Ernie had answered him and had left. I can't remember if it was James or Orlando had mentioned the question earlier about, am I expecting to get assigned? Well, yes, when I enter into one of these standard collar positions that we spent the beginning of the presentation on, I am expecting to get assigned. I don't want to take the risk or take the chance of even a stop loss that might get violated. That's why I'm using the standard collar. But I am expecting the stock to move up and get assigned. Well, knock on wood, we know that doesn't always happen, and I like it to happen more often than not, and typically it does. But some months you're going to get caught in positions where you might not get assigned there, and you may end up with a loss. The radioactive trading methodology takes a married put position with very limited risk and unlimited upside profit potential, and then outlines the 10 income methods that we use to lower our risk on the position but still keep our unlimited upside profit potential on stocks we're expecting to grow over time. Okay? You can read more about this at radioactivetrading.com. The full methodology there, the blueprint, is available right on the site. If you go to radioactivetrading.com, make sure that if you haven't yet, to go ahead and download what's called the sketch. There's a simple form, put in first name, last name, and email address. You can get Kurt's 9-page white paper there that introduces you to his methodology. Again, as many of you received an email this month, we're doing a lot of webinars this month. We're doing a webinar every day, at least one webinar every day except for on Mondays. Every Tuesday at noon Eastern and Thursday at noon Eastern, I join Kurt, and he does an hour and a half presentation on his radioactive trading methodology. Okay? All right. Now we want to talk a little bit about Power Options, some of the tools that we saw tonight that we're going to go in more depth into next week, both into the search capacity and into the management techniques. If you haven't yet, I just remind you, go to PowerOpt.com, www.poweropt.com, and you can sign up for a free trial. All it requires is first name, last name, and email address. Okay. Our 20-minute delayed service gives you access to all the tools on our tool menu with 20-minute delayed quotes. It's only $59.95 per month, or a discounted rate of $600 for the year, essentially paying for 10 months but getting 12 months of service. We offer a real-time service at $79.90 per month, or a discounted rate of $800. And we also offer historical backtesting tools where you can backtest your different positions, your different criteria. The backtesting feature is not available on the 20-minute delayed or the real-time, but you can subscribe for a 3-month subscription to the historical access for $99.95 for a 3-month access, or you can simply upgrade to the professional level of service. It's about $100 per month. It gives you access to all of the features on the real-time with unlimited access to the historical data included. Okay? Now, questions. I'm going to handle some questions, but I'm going to leave this slide up as well. So if you have any questions at any time, please feel free to email us to support@poweropt.com. You can call us toll-free during market hours at 877-992-7971 if you live inside the continental U.S., or call us at 302-992-7971 if you live outside the continental U.S. There's contact links on every Power Options page, and as I mentioned, just look out for the collar presentation thread. It's just going to be under the collar strategy in the Power Forum on Power Options. And I am going to be emailing everyone that attended tonight about a little recap on this presentation and what to look forward to next week. Okay? And I'm going to go through now and take a look at some of the questions that came in. There's Orlando's question again. How do I adjust the short calls if I'm still bullish? Okay, now let me take a look here at the attendee list. It's Adriano, okay. Well, I actually approach this the same way that I approach a standard covered call position. Okay, so going back to our RIMM position, remember we had sold the 70 call, bought the stock around 68.25, sold the 70 call, and at the same time had a November 65 put option. Okay, so if the stock started to move up and I thought I saw something on the horizon where I wanted to keep RIMM in my account and I didn't want to let it get assigned at $70 per share, well, the best thing I can do is move to buy back that 70 strike call and then maybe roll it to the December 75 or a different strike price depending on what's available. Okay. Now, when I do that, I'm also going to have to adjust the put, aren't I? Because the put's going to expire in November. That's the tricky part about the standard collars, okay? If you're still bullish and you still want to be in the stock, you have to adjust the call and the put. Adjusting the put every month, buying a just out of the money put month by month by month, by the end of a 6-month time period, you're probably going to end up paying twice as more. Adriana, what I really suggest you do, a better way to trade positions on stocks that you're bullish on for a longer time period, is go to radioactivetrading.com, download that sketch there, read a little bit about Kurt Frankenberg's methodology, because this will put you in the right place where you can enter in positions where you have limited risk over an 8 to 10 to 12-month period, but still have unlimited upside profit potential and can make adjustments to bulletproof the position. Okay, so when you get a chance, Adriana, go to radioactivetrading.com, fill out the form there, just first name, last name, and email address, and click Get the Sketch. And join us for Kurt and I for one of the webinars next week, Tuesday or Thursday at noon Eastern Time. Orlando says a discussion on the back testing would be great. Orlando, I am going to save that presentation on the back testing in general, not particularly on collar spreads maybe. Maybe I might do that then. But a distinctive discussion on the back testing and the back testing tools on power options, I'm going to save that to November. We're going to churn out some of these strategy discussions first and have some of the open discussion forums on Fridays. And then come November, we're going to focus on the back testing features and how they can be used. Okay? All right. Do you provide one-on-one mentoring? Well, what we do, Adriano, is if you are a Power Options trial customer or if you are a subscriber to Power Options, you can sign up for a free coaching session. Once you log on to your account, when you're on the main home tab, you'll see a link there for free coaching session. This should actually be called free coaching sessions. They're unlimited. The coaching session is essentially a 35 to 45-minute phone conversation with either myself or Ernie Zerenner. We'll spend one-on-one time with you, answer your questions, get you acquainted with the tools. We can talk about the strategy as we did tonight. You know, why is one strategy maybe better than another based on what your sentiment is, what your threshold is. What I can't do, Adriano, and what I won't do is I won't give you advice. I won't tell you how to trade. I won't tell you to always do this and always do that. But you can have the free coaching sessions, and I'll walk you through it, talk about the risk and reward in the position, talk about information I have obtained. Okay? All right, JN asked, I own the blueprint. Hey, that's great. Is there a small fee for an upgrade to the current publication? Yes, if you were already a blueprint owner, if you've already purchased the blueprint, there are now 10 different income methods in the blueprint. You might have a version that has 9 income methods or 6 income methods if you bought it a while ago. But the latest edition, I believe it's the 5th edition. Since you've already owned the blueprint, you can have a new one sent to you with the new information for $29. If you still have your user ID and password that you were given when you first purchased the blueprint, the free access registration to Radioactive Trading, you just go to radioactivetrading.com, log into your account, and when you go into the products page there, you'll be able to see that your blueprint there is only $29. And if you don't have that, simply send us an email. Send Kurt or I an email. Just send it to support@radioactivetrading.com, and we'll make sure that we have that user ID and password for you and the information that you need to get the most updated version there of the blueprint. All right. Okay, are there any other questions? I'm going to leave. I know we went over. I apologize for that. Went a little bit in the search tools. Maybe we bounced around a little bit too much, but that's okay. I hope you guys got a lot of information. I'm going to leave it open for another minute or so. If anyone has any last-minute questions, go ahead and send them my way. If not, just remember, check out the Power Forum there on Power Options. It's only available to free trial members or Power Options subscribers. But for the next 2 weeks, if you don't have a trial, you can sign up for a trial and follow the discussion there on the Power Forum. I encourage everyone to get involved there. I encourage everyone to get involved with the discussion. Even if you didn't like this presentation, even if you thought the presentation was lacking, I want you to post that on there. I want you to tell me what could have been better. I want you to tell me what kind of strategy techniques you would have liked to have focused on more, or what kind of features on Power Options you would like to focus on more. And that'll help us for Thursday. That'll help us for next Thursday night at 6 o'clock Eastern when we talk more about the management and we talk more about the search tool a little bit more and some of the tracking positions, okay? And also remember, you're going to get a recap email from me. This might come out Saturday. This might come out Sunday. I might send it out on Monday as well, just to get you prepared for Thursday. So look forward to that as well. And again, anytime you have any questions about this presentation, any of the other 23+ strategies on Power Options, any of the tools on Power Options, go ahead and send us an email to support@powerop.com or give us a call during market hours, okay, 877-992-7971, or if you're outside the U.S., 302-992-7971. All right? Okay. Thank you, everyone, for joining. I don't have any other questions, so we're going to go ahead and shut down. I hope you enjoy the rest of your evening. I know I'm going to. And I hope to see a lot of posts coming into the forum and a lot of discussion over the next couple days. And I look forward to seeing all of you on Thursday. Uther, Adriano, you're all welcome. Thank you for joining me. It was great to see you here. Take care, everyone. We'll talk to you soon. Good night.